Singapore's 2026 growth forecast just got a major bump, but a bigger number is not automatically a better one for every household. When you look past the headline revision, the story underneath is a lot more uneven than it appears at first glance. This is one of those weeks where the headline number and the real number tell two different stories, and I wanted to walk through why. I have been tracking this release since the Ministry of Trade and Industry issued it, and something about the breakdown underneath required a closer look. Let's break down what is actually driving this upgrade. MTI raised Singapore's 2026 growth forecast from 2 to 4%, all the way up to 4.5 to 5.5%. That is a genuinely large jump within a single year, marking 3 separate upward revisions. My first reaction was relief because a bigger number sounds like good news. But my second reaction, the one that actually matters for managing retirement savings, is to ask whether every part of the economy is actually sharing in this momentum. Let me show you who this actually impacts. I am not usually the one reading a Ministry of Trade and Industry release. But for anyone managing CPF and SRS money, the real question is whether the economy is broadly stronger across the board or whether one part is lifting while others quietly fall behind. That answer turned out to be far more lopsided than expected. Here are the official numbers so far. Singapore's economy grew 6.1% in the first half of the year, with second quarter growth coming in at 5.9%, revised up from an earlier estimate of 5.7%. With the full year forecast now pushed up to 4.5 to 5.5%, it is worth asking why the forecast kept rising rather than simply accepting that it did. The answer comes down to two very distinct forces. Two very different things are happening simultaneously in our economy. One of them is doing almost all the heavy lifting, while the other turned out to be less damaging than feared. Understanding this distinction is critical before drawing conclusions about your own portfolio. Let me walk through the first major driver. Manufacturing output surged 12.5% year-on-year, driven directly by electronics and precision engineering clusters supplying the global artificial intelligence build-out. Wholesale trade grew 8.3% on machinery and equipment, while finance and insurance rose 6.2% on strong credit growth and fee income. All three major clusters are being lifted by the exact same global tide, demand for AI semiconductors and infrastructure. But there is a second, quieter reason for the upgrade. Back in May, MTI held its forecast steady due to conflict involving the United States, Israel, and Iran, alongside fears of Strait of Hormuz shipping disruptions. What actually followed was much gentler than feared. Countries drew down existing oil inventories and shifted to alternative supplies, which kept a firm lid on energy prices instead of triggering a full-blown shock. Here is how those two elements combine. This upgrade reflects two separate tailwinds arriving at the same time. The thing we feared turned out less bad than expected, while the thing already going well went even better. That is not one steady, broad-based improvement across the whole island. It is two specific pieces of good luck working together. That brings me to a personal observation. I think about this the way I think about my grocery budget. If the price of chicken drops, but my vegetables go up by the exact same amount, my total bill looks completely unchanged on paper. But my actual week feels very different depending on what I'm cooking. This national growth figure is real and large, but it is landing very unevenly across Singapore. So which part does your household actually touch? Whether your household feels the benefit of this record upgrade depends entirely on which sector you touch. The headline upgrade is certainly not fake, but it demands a second practical question before anyone celebrates. We have to look at the sectors that are not participating in this boom. Let's turn to the data on contracting sectors. Food and beverage services actually contracted 1.5% year-on-year. MTI pointed to two specific pressure points dragging it down simultaneously: Singaporeans traveling and spending overseas, combined with softer tourist arrivals spending less locally. That is a fundamentally different economic reality than what a semiconductor firm or bank is seeing. Let's compare these two experiences side by side. If your household works in finance, electronics, or precision engineering, you are seeing stronger bonuses, secure hiring, and a genuinely brighter outlook that you can feel directly. But if you rely on food and beverage, local retail, or tourist footfall, this week's national headline does not match your lived experience at all. That divide is essential to recognize. A big national number does not automatically trickle down evenly into every corner of the market. That gap deserves honest acknowledgement rather than an unexamined assumption that everyone is winning. We also have to keep an eye on the forward-looking risks. Here are 3 specific threats MTI flagged. First, a Middle East escalation could cause energy prices to spike. Second, potential U.S. tariff actions could dent overall business and consumer confidence. Third, any sharp correction in AI spending enthusiasm could pull back manufacturing momentum quickly. An upgrade built partly on the worst case not happening yet is a vulnerable kind of upgrade. Before I get into what this actually means for your own portfolio, a quick word on where the fuller forensic breakdown lives. In this market, the line between securing institutional sanctuary and stepping straight into a yield trap is decided in a single trading session. If you wait for the mainstream narrative to publish a summary, the entry window has already closed. Today, we break down why speed and forensic execution are the only things standing between a sustainable dividend runway and a capital loss. If you want Iggy's full forensic take on how this growth picture affects specific stocks and REITs, that deeper breakdown is available to Iggy's elite investors. Get everything: 0-day access on both platforms, full red zone watch list, institutional grade cheat sheets with Iggy's elite investors, 12 Singapore dollars a month. Now let's connect this back to your retirement capital. A strong headline economy is generally supportive for CPF and SRS capital because it underpins broader corporate earnings, employment, and REIT distribution stability. If you hold a broadly diversified portfolio, this revision is encouraging news. But if you hold concentrated positions in local retail or consumer sectors, assuming a rising tide lifts all boats equally, that assumption needs gentle correction. Let's examine why consumer sectors remain under pressure. Consumer-facing businesses like retail and food and beverage continue to face ongoing margin pressure from inflation, even as Community Development Council vouchers help cushion daily household spending. A record growth year for GDP does not translate into lower daily operating costs or cheaper living expenses. This leads directly to another practical reflection. My daughter asked me recently if a strong economy means everyday things are getting cheaper, and it made me realize that strong growth and cheaper living costs are not the same promise. The sectors pushing Singapore's GDP higher this week are simply not the ones most heartland families interact with at the wet market or hawker center. Here is where I land on this report. This upgrade is genuinely good news driven by a powerful global AI boom, paired with geopolitical risks that turned out less damaging than expected. But neither condition is guaranteed to last forever, and neither applies evenly to every sector. Both truths are worth knowing honestly rather than folding them into one single, reassuring headline number. That leaves us with one essential question. The question every retail investor should ask today is not whether the national economy is growing faster than expected. It is whether your own income, business, and portfolio actually sit inside the specific sectors driving this upgrade. Let's look at how to evaluate your answer. If your portfolio or livelihood sits in finance, electronics, or precision engineering, your answer is a genuine yes, and these numbers offer clear fundamental backing. But if your exposure is tied to food and beverage, local retail, or tourism, the honest answer might be not yet. Sitting with that distinction objectively is far safer than assuming a high national figure protects every stock equally. Singapore's growth upgrade is real, but it is highly concentrated in global tech and financial flows. Understanding where your capital actually sits is the difference between riding a genuine tailwind and holding a stagnant sector. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.